We have Brent Shear talking about maybe an opportunity to help your clients with some additional revenue via 1031 exchange. Brent is our Chief Operating Officer, Senior Vice President, and take it away, Brent.
Good afternoon. So we are going to follow up the exciting FinCEN talk that Vince had, which she did a great job on. I've been following that, as hopefully you guys all have or reluctantly have. It's a major change. Probably hits a small percentage of our transactions, but you got to be ready for it on every one if it hits. So Vince did a great job. So fortunately or unfortunately, we're not going to talk about that anymore. We're going to talk about 1031. So this particular topic for me, I'm a recovering tax preparer. I'm a recovering auditor as well, certified public accountant for whatever that's worth. Tax and 1031s obviously are something I've run into over the years. As a tax preparer, one of my worst things to have is a client walks in and is like, hey, we did a 1031. And, it's like April 1st. And it's like, what? So one of the things you'll hear me say is make sure your client, if they're talking about doing one, please talk to their tax preparer. Big deal, because it can impact all kinds of things. I'll explain some of those as we get into it. Let's get started, Drew. Next slide is our the introduction. So the concept, we'll talk about investment properties. You can hear me say that a lot. Investment properties can be real properties, real properties, residential properties. A lot of people own rentals. Those are residential properties. You did hear Vince say, and for whatever it's worth, if it is a 1031 transaction, it is exempt from the FinCEN transaction requirement. So the law allows you to defer, and so that means that you don't have to pay capital gains now. At some point you will, unless you are able to be, cynically a very good tax planner and plan your death, and then you get the estate tax treatment. So we won't be morbid, but i.e. you're going to pay it at some point. Somebody will. Tax benefit, obviously, not having to pay the taxes at the transaction as part of the transaction in the current tax year gives you a little more liquidity. So you take that money, roll it into the next one. So anyway, we'll explain how that works. Next slide. Again, guys, if you have questions, please holla. Always open to take them. And then, as a little reminder, make sure for Drew that you've turned in your NPN number, CLE, bar number, whatever number it is that we need to give to our wonderful folks that track our licensing renewals, so we can get you guys the hour, 2 hours, or 3 hours credit that you want. So anyway, words to know: accommodator, basis, boot, direct deeding, replacement property, the QI, the qualified intermediary. That's what we help to do. Qualifying property, safe harbor, direct deeding, that twice, never noticed that. And relinquished property, long word for what you're selling. Next one, please, Drew. So Starker, who is this guy? So you heard real estate agents like, yeah, we're gonna do a Starker exchange. I don't even know that they know what it is. Frankly, I'm not sure I knew what the heck it was, but you look them up, well, there you go. It was the start of what we all know as the Section 1031 exchange deferral. A gentleman by the name of TJ Starker, I believe that is him right there. So paying homage to Mr. Starker. Was able to convince the IRS that we should be able to time delay the exchange of property, i.e. defer taxes. So there you go. Now you know who Starker is. Heck, you even see him right there, Mr. TJ Starker. God bless him, he beat the United States. So that's worth something. Next slide. So you heard me talking about when clients would walk in and we're talking about the year catching up, and then like, oh yeah, we did a 1031. So I think one of the things that we always encourage, we do is secure security title. We have a subsidiary that can handle 1031 exchanges. So FYI, if you have one, please let us know. We can help you. But one of the first things we do when we talk to the clients is, hey, have you talked to your tax preparer? There's a lot of things that happen in that conversation. Number one is you have to understand as a tax preparer, or sorry, as a client or a person who's contemplating doing a 1031, what's the ROI? What's the return on investment? What's the investment? Well, you're going to spend some money. Call it $1,000 for a standard forward exchange. 5,000 or more on a reverse exchange. So we'll get into that. But it's not cheap. But it definitely is a cost, and you need to make sure it makes sense. And so, for example, if you own a piece of property and it costs you $90,000 to acquire it, and you're going to sell it net of transaction costs, realtor fees, etc., for 100, you're only going to save, your gain. The 100,000 net fees less the 90 is $10,000 gain. Is it worth the trouble to go through and hold the money up for 180 days and go through the process for 1031? That's their call. But you find often that there's just not a lot as much gain as you thought. And so, especially with some of the properties, it depends when you bought it. If you bought a property prior to 06, or up to that point, but we've seen a ton of appreciation lately. So these things are getting popular again. But we always want to make sure we know what the cost benefit is. We also want to know what the tax basis is. The tax basis may not always equal what you paid for the property. So again, having that taxpayer involved, CPA, engaged agent, whoever that person is, just make sure they're involved. The other thing that's super important about getting the CPA involved is this. So let's say you're doing a transaction and you're closing the relinquished property, which is the one you're selling on a standard forward exchange. You're closing it, let's say in December, pretty common. That means you have to extend your tax return because you've got up to 180 days to go buy the replacement property, i.e. the property you're buying. And so if you file your tax return for, let's say, 2025, and you sold a property in December of 2025 under 1031, and you go ahead and file your tax return because you're a good person and you want to file it on time, you just killed your 1031. So that's the other reason to make sure that the tax preparer is aware of this, because in that case you have to file an extension to preserve the full time needed to get the ability to defer taxes. So there's a couple big things that always need to have the CPA or tax preparer involved. All right, Drew, next one. So what is a QI and why is it needed? Well, the QI is kind of like Switzerland. The qualified intermediary is, kind of the way that the tax regulation was formed or conditioned or accepted or reasonable standard, if you will, is that, okay, fine, Mr. Starker, we'll let you defer the gain. However, you cannot have the money. And so that means that there was this concept of an intermediary, someone you trust, and title agents often do this in terms of as a ancillary business, but you also have dedicated qualified intermediary businesses, which is one that we work with. And what that whole job is, you're Switzerland. You're getting the money from the taxpayer at closing. So we'll go over this, but when you look at a 1031 transaction on the relinquished property, again, the one you're selling, the net proceeds are going to go to the QI, not to the taxpayer. It's kind of like 401k rollovers. You don't get the money and then send it on to the next, investment broker. The money goes straight to the broker, and that's kind of the same thing. You can't touch the money. So the money goes to QI, and then you've got 180 days to close the next one. So, and the why, as I mentioned, is that so that the taxpayer does not have access to the money. So there's a little bit of liquidity penalty, if you will. You can't touch the money. And so in a reverse exchange, what's even weirder is that the QI actually buys the property. So a reverse exchange is exactly as it says. It is in reverse, meaning you buy the replacement property before you sell the relinquished property. So in that particular case, obviously an LLC is set up. It's called an exchange accommodating title holder, or EAT. What are we good at in this business? Creating acronyms that no one else understands. Anyway, now you know another one. EAT. So an EAT or an E is created, and that would buy the property. So again, QI is critical in terms of getting a 1031 transaction that will qualify for deferral of taxes. Now, the other bullet point I would make here with the IRS, different from our legal system, the IRS is basically governed by an administrative system. So there's no prior case law. So when it comes to, can we do something, or what's the rule? There's obviously a regulation out there. It's an administrative process. But just because Joe did it and got, a favorable decision doesn't mean you can do it. There's no prior case law that they rely on. So everything is, as I like to say, just keep it between the guardrails. Yeah, Joe did that. He was favorable. Let's do that. But we just always recognize that there's no prior case law. So if you're doing something, you're doing it hopefully, with the advice of a tax attorney or a CPA or someone with experience. And two, you've documented your reasoning, et cetera, et cetera. So you'll find some nuance in some of the 1031 transactions that get done, construction improvements, et cetera, that can get a little bit gray. So again, you can take risk, but it could be disqualified. So anyway, next slide. Intermediary. So who can be an intermediary? So we mentioned kind of what they are, what they do. Really anybody. There's been, if you guys remember in the 08 crash, 06, I think there was a QI that was buying other QIs and then left the country like $200 million out of Nevada, if I remember right. Not good. So there's been some regulation on a QI, but frankly, not a lot. So it's super important that the client and you, if you're using a qualified intermediary, you know exactly who they are. That they are obviously trustworthy, valid, a going concern entity. So it's super important you know exactly who you're working with. Who can do one? I mean, obviously title companies can do it. Some tax accountants do it, attorneys, even realtors. And there's standalone companies. You cannot provide, as part of a QI, you cannot provide tax, legal, or financial advice. So you're just Switzerland, right? You're just like, look, you tell me what to do, I'll do it. Now we'll talk a little bit about, kind of the reasonableness standard, if you will, that I like to follow, and kind of, if you know something's wrong, you shouldn't do it. But because there are rules that we can all follow. So criteria, again, there's not really any formal licensing requirements. In some states, I think Nevada, do have some requirements related to that, but generally nothing formal on a national level for sure. And a few states have it. So anyway, so next slide. I think we might have skipped 2 there, Drew, or maybe go back 1. Oh, yeah, I think you're right. Okay. All right, things to consider when choosing. So obviously, as I talked about, the experience, you can verify reputation. They should have a fidelity bond. They should be a tax professional, understand the tax code. And then there is an association of the Federal Federation of Exchange Accommodation Title, or Federation of Exchange Accommodators, FEA. Again, another acronym. So FEA is a membership of nerds that do 1031s. So if they're a member, obviously that means something. But all of those things would indicate, hey, you're dealing with a reputable firm. Obviously, you get some referrals, somebody you know has used them, et cetera, or you use us, which you do know us, so that's good. So anyway, next slide. Some more information here, just and kind of almost about best practice, like what you should expect to see. So exchange funds should be held in a separate bank account. So I know that as title companies, we have an escrow account, and we'll have multiple deals in the same escrow account, right? Best practice for a 1031 exchange is to have a dedicated single account in the name of and the EIN. Entity identification number, employer identification number, whatever identification, social security number, etc. That is how it's registered. So this is a single account for the sole purpose of taxpayer ABC under their social security number, or ABC LLC under their EIN. And it can be an interest-bearing account. It should be reconciled, FDI insured, et cetera, is kind of solved with that setup, as we all know. So, so if you look at your three-way reconciliation as a title company and you have an escrow account, well, when it comes to holding escrow funds as an intermediary, you literally might have 20 accounts open at one time. So your three-way is basically like, well, I mean, technically they're all dedicated accounts, so it's a little bit easier in that regards. However, you have to set up an account for every single client. Fortunately, banking has gotten more sophisticated online, so it's fairly easy to do. The nice thing is, if there's an interest component to the account, then the taxpayer has the ability to get that directly in terms of the reporting, the 1099 INT. So it's always nice to have that kind of taken care of as well. But obviously, they collaborate with the title company quite closely as they go through the closings of both the relinquished and the replacement properties. And then, do they have the ability to do the exchange, reverse exchange? So, so anyway, all of those things are super important. Next slide, please. Any questions to this point? Don't see anything on my end, but Drew, I think you have them. So anyway, so connecting the QI to the client. So we have an exchange agreement. Me as the number nerd, there's a lot of words in it. So might want to read it, make sure it's good. These are pretty standard, agreements these days. I know some attorneys like to draft their own each time. For the most part, the ones that we utilize are templates. It's pretty straightforward. There is an assignment of the purchase contract. So, taxpayer ABC is in a purchase agreement from seller, Bob. And one of the first things you do once you sign the exchange agreement is you assign the purchase agreement to the qualified intermediary. So again, tax code, nerd stuff, but the buyer actually is going to look like it's the QI. And so you have to give a notice of assignment to the seller. So, and again, just part of the rules that you have to comply with to make sure, again, we have no prior case law. So we just know that everybody else does this and they haven't questioned it to date. So let's just keep doing that. So anyway, so Drew, you can go ahead and get to the next one.
Sure. Actually, there's a question here, and it might be a good time to do that first poll question too.
Yeah, go ahead.
So let's see. So to clarify, a title company cannot hold funds in escrow account, but instead in a new account? Question mark.
Well, if you're the QI, so if the title company in question, if you're the qualified intermediary, then best practice is you hold qualified intermediary funds in a separate dedicated account. That's what everybody's doing now is QIs. This kind of stems from the 06 chaos of the Nevada company that was just bolted with all the money. So that's really a best practice, kind of a required, if you will. There's no, to my knowledge, there's no IRS guideline like that. But again, this is kind of best practice within the industry. Like as a qualified intermediary for a transaction, you have to, you want to hold that money in a separate account. So again, you're the QI, not the title company. The title company works with the QI. So happy to follow up on that one. All right, next slide. These questions are awesome, guys. Keep them coming. One of the things I think is always fun with this stuff is one of the standard answers is it depends, because we're making a lot of assumptions in answering some of these questions. So there's a lot of context around them and nuance. So it makes it fun. Okay, so basic rules. So the relinquished property must be qualifying property. How must be the same? What does that mean? Well, qualifying property, they cleaned this up a few years ago, and I can't remember. I want to say it was in the 2016, 2017 range. You used to be able to use like-kind exchange or 1031 exchange. Like-kind exchange is another pseudonym for it, if you will. That if you had a piece of art, that you could swap one piece of art for another. Cars, investment property was pretty broad. They basically shoehorned it into real property. So it's basically, land, buildings, any of that. Now, if it's real property, I mean, it's pretty broad. So you can change out raw ground for an apartment building, so you can drive a truck through that one, but you cannot involve like cars or fixtures or artwork or any of the stuff that's considered personal or non-real property is maybe the best way to say it. Second thing here, the point I'm trying to make is that title must remain the same, meaning if Brent Shear sells the property, Brent Shear also needs to be the buyer of the replacement property. You often hear people's like, okay, yeah, I've got this property and it's in my husband and wife, my wife and I's name, but we actually want to put it in an LLC. I'm like, look, do that before the transaction or after the transaction. But once you've started the transaction, it is staying in the name of whoever has it. Now, again, with FinCEN, that's a whole nother ballgame now, because you used to be able to, LLCs, again, the recovering tax preparer here, LLCs are typically how you hold property that goes up in value. And so you would, easily move property into an LLC. Of course, now you make sure you're following FinCEN, because that potentially could be a red flag. So anyway, by the way, I don't know that we can do a show of hands, but has everyone seen Ozark? Because it is my opinion that the FinCEN nerds watched Ozark and said, holy cow. And then they started, this whole chaos that we now have to deal with related to money laundering. Because why? Well, it works very well. Anyway. So you can go on to the next one. So property that does not qualify. So, again, we talked about what is qualifying property. Well, maybe the best way to answer that is what is not qualifying property? Well, a personal residence, land under development for resale, that is inventory. That's not investment property. Personal residence, obviously, is pretty straightforward. Construction, fix or flips for resale, again, that's considered inventory when it comes to taxes. Then property purchase held for resale, again, inventory. So those are pretty straightforward, and I'm fortunate I got a picture of a bulldozer on here. So that's when I grow up, I want to be a farmer. So by the way, next slide, please, Drew. More examples. These are really, I'm an accountant and CPA, so art to me is a spreadsheet with colors on it. So this is pretty artsy fartsy for me. So anyway, bear with me. I know that more folks are probably way more advanced in terms of artistic. My daughter, for example, being one of them. Inventory property. So again, I mentioned those 3 examples previously. Inventory just does not, it is operating, not investment. Common stock, bonds. We think of bonds, we think of Die Hard and negotiable bearer bonds, right? From the German guy who was a real, well, rear end. Notes, partnership interests, none of that stuff qualifies. Keep going, Drew. Okay, so replacement property must be like kind. So you heard me mention like kind a couple slides ago. Here we talk about it a little more interchangeably. For real estate exchanges, it means improved or unimproved. So pretty broad. Improved real estate or unimproved. 100% can be exchanged for an undivided percentage interest. One property can be exchanged for 2 or more properties. You can have, one to many or many to one. Title must be taken in the same name as a relinquished property. So again, that was kind of the rule I mentioned earlier. So nothing new there. Keep going, Drew. Boot. Again, very artistic on my behalf. I'm going to tap myself on the back. I threw an image in here. Pretty impressive under my own very low bar for artistic ability. Any boot received in addition to like-kind property will be taxable. What is boot? Well, cash. So for example, you have a property that you are selling that's worth $250,000, and the property, so you get that money, and then you buy a piece of property that's worth, you sell that property for $250,000, and you take cash on the transaction. You pull money out of the transaction. So that would be boot. That's going to be taxable. So you just take whatever percentage of gain you had, and you're going to pay taxes on it. So generally, we like to avoid it at all costs. Another example would be, the property you sell for $250,000 and the property you buy is only $200,000. Well, $50,000 of that's going to be exposed to taxability. So again, general rule of thumb is whatever we sell for, we want to buy more. So $250,000, buy at least that. And it's the sales price, not the cost basis, because your cost basis can be wildly different. So if you sell for $250,000, you want to buy something or a couple properties that aggregate to at least $250,000. And that way you never have to worry about cowboy boots. There you go. Go ahead, Drew. So basic types of exchanges, the simultaneous exchange, same day. If I remember right, Starker was doing something like that. Those are rare. I think I've heard of one of those in my experience. So I don't do a ton of these, but that is, they do happen. You just walk in, swap deeds, done. So if that happens, then, you defer any taxes and cost basis, etc. Delayed exchange, which is what is the standard 1031 exchange, sell today, buy at a later date. And then finally, the reverse exchange, title holding exchange, buy today and sell at a later date. Go ahead, Drew. The exchange process and time clocks. So again, buyer's found, contract to sell is executed. Big point here, accommodation language placed in the contract. So again, this is part of the ability to give notice to the seller that this is part of a 1031, and that you have to put specific language in the contract to that end. And obviously you assign the contract. Contract's executed, and you become the substitute seller. Clock begins. Go ahead, Drew. Next one. So more than one potential property identified. So again, you gotta love this. Come up with rules for everything. So 3 property rules. So just out of the gate, let's say you're selling a property for $1 million, and you can identify up to 3 properties without regard to their value. So for example, you're getting ready to sell it. You haven't got the replacement property under contract yet, but you got 3 properties you're looking at. You can identify those 3 properties within 45 days of selling. But here's the catch. you always have to provide this 45-day letter, right? And if those 3 properties that you identified, you do not close on those within 180 days, and the 45 and 180 is concurrent, meaning 180 days is the total time length. You have 45 days within the 180 days to give notice of what properties you're going to buy or your replacement properties. But if you do not close those 3 properties within the 180 days, you can't pick a 4th property. So that's it. She really kind of the hard part about these 1031s, and again, this is why the ROI has to be there, is that you put additional stress and additional regulations on a simple buy sell. You know, the good news is you get to, obviously defer the taxes, but the bad news is you've got additional rules, and sometimes, especially in real estate, and you guys all see this every day, deals blow up all the time. I think you see anywhere from 25 to 30% of all deals just don't happen. So anyway, so the 200% rule, that means more than 3 properties can be identified. However, cannot exceed 200% of the value of the relinquished property, say properties. 95% rule, any number of properties if they purchase at least 95% of aggregate value of all identified properties. So, again, you're really kind of putting yourself in a box here, and if you not able to execute, you risk the ability for the tax deference. So anyway, failure to submit 45-day cause the exchange agreement to terminate. And this is a big bullet point too. We got one going on right now where it looks like they're not going to be able to close on the 3 properties identified. You wait, you sit on that money for 180 days. Now, if you don't find 3 properties within 45 days and you never turn in the 45-day letter, that terminates the agreement. You can get your money. Now, you're going to have taxability, right? You're going to have to pay taxes on it, but at least you get your money. If you identify 1 or 3 properties, or under the 200% rule and 95% rule, that money is held for 180 days. There's no early out. So you got 3 main points here. One is you want to do a 1031 at closing, and of course you need a couple of days at least to get ready for it. 2 is you go ahead and execute 1031. Your next out is the 45-day rule. So if you don't have 3 properties identified, or you don't like the properties you think you can replace it with, you can get out then and get your money. But if you don't, then that QI has to hold that money for 180 days. There are no early outs. But anyway. So we already talked pretty exhaustively about the 45-day rule and kind of touched on the 180. As I mentioned earlier, once you make it past 45 days and you identify properties, you're ride or die at 180 days. So you got to get it done. Those things that, again, just a little bit of stress there. So careful what you wish for. You want to chase that deferral. Obviously makes sense if it works, but it is a little bit of stress. So anyway. Go ahead, next slide. Reverse exchanges, they're largely exactly the same. There is a 5-day addition, and the reason is so reverse exchanges, you flip it basically. So you buy it, as I mentioned earlier. You have an EAT, an exchange accommodation title holder agreement or entity. So the QI sets up a literal LLC to be an EAT, which now that you got BOIR rules and FinCEN rules, like God help us, right? But anyway, set that up. You work with the exchange accommodation title holder, QI, to buy the property. They buy it. So your lender's got to know, hey, I'm lending money to an EAT. Or what? So I mean, it's a lot. But your QI will help you, and then you get the property purchased, and then it's in reverse. So you got 45 days to identify the property you're selling, which ought to be pretty straightforward. Either you own it or you don't own it, right? So and then you've got 180 days inclusive of the 45 to sell it. So again, you're really rolling dice here, because especially in a market like now where it starts to get a little hard. And you got to find a buyer. So if you don't, then, again, the EAT and the 5-day rule comes in. After the 180 days expires, the EAT has 5 days to transfer ownership over to the client. I always just transferred membership shares. So I would set up, an LLC, EAT, whatever we called it, EAT, ABC, LLC, whatever. I would just transfer the membership shares versus having to go through and do recording, especially with FinCEN now. But anyway, that's kind of, you get 5 days to kind of administratively handle that. So anyway. Okay. Yep. Related party exchange. So you can do it. And it's a little weird to me as far as like, how do you actually like enforce this? But you can have related party exchanges. So again, I sell a property to my brother. Okay. We can do that. But you have to hold, Ryan, my brother, would have to hold the property for a certain period of time. I guess it happens. No idea if it actually gets caught if you don't. But anyway, so who's a related party? Members of family, an individual in a corporation, i.e. I'm the CFO of a company, and I do a transaction to corporations who are under the same family of companies, trust fiduciary and a corporation, again, that are related, and a person in a partnership, a member of a partnership and a partnership. So generally, an LLC, you can just transfer the property and assume the tax basis. So no need for a 1031. Of course, FinCEN might be triggered, but that's another story. Next slide. And so I think we're going to say, so exchange property, just a special rule, sale to unrelated property, replacement. So ask if related party is doing the exchange. And then generally, you got to hold it for 2 years, is what I was going to tell you guys. So sale to a related party, replacement from an unrelated party is okay, unclear on requirement for possession. So generally, and again, this is kind of, there's no prior case law, but generally it's 2 years. So that is kind of, I don't even know if you want to call it a safe harbor, but generally that's kind of looked upon as a generally a safe time period to hold it. So it can happen, but you just have to be aware of the special rules involved. Go ahead, next slide. A TIC, tenancy-in-common, so investment of taxpayer in real estate, which is common with other investors. These are just a little bit, you just got to make sure you cover your bases, because remember, the titling of the property must remain the same. You can do undivided interest though. So we're selling 10% of a property and 10% in buying another property. So these get a little bit squishy. Again, just work with a good tax attorney, real estate attorney who knows this, and just make sure you cover your bases. But it can happen. But just be aware that it's a little bit squishy. So go ahead. Next one. Yes, so we just talked a little bit about what they look like, multiple tenants, et cetera, et cetera. So obviously we're talking about apartment buildings, office buildings, that kind of stuff. Go ahead. So this is just kind of operationally, as a title company, what are you looking for? Well, just make sure you know, it's kind of like when you do a transaction with an LLC or a corporation, who's signing. Make sure you know who you're talking to at the QI, because they're going to be your collaborator, because they're going to help you get documents. They're going to have documents for you to make sure that gets signed at closing, whether it be the buy or the sell, the relinquish or the replacement. Make sure that you're comfortable with the accommodation language. It should be very straightforward. Oftentimes you're going to see a checklist of what is needed prior to closing. Settlement statement. So next slide, Drew. Settlement statement is going to include probably, and this is how I like to do them, in the signature line, you're going to see the intermediary identified. So in our case, Secure 1031 Exchange LLC is our example here. Exchanger, John and Jane Doe. So that is the client. That's probably, in this case, John and Jane Doe are the title, or in title as husband and wife, you assume, and then the address. So it's very, very clear that this is a 1031. So we're just making this happen. You guys all know that last minute changes to contracts always happen, purchase contracts. So we've got to sign it to so-and-so because we sold it as Brent, but it's actually Brent and Angela. And so we need to make sure we document that in the purchase agreement that it's Brent and Angela that own the house. And in this case, and they're doing 1031. So there's assignment to the 1031 intermediary. So all these things, as you all know, are part of the normal horse trading that happens at the closing or just prior to closing. Go ahead to the next one. Recommendation to credit zero proceeds. Yes. So again, we want to avoid boot. The transaction, obviously, we hope it has none of that. So I always like to see zero proceeds due to. So what that means is I put in the bottom section of the old HUD, because again, we're doing investment property here. So it's a commercial transaction. I always like to put that as like in that second section on the bottom right. For seller proceeds, you just show the net proceeds, just a plug to the QI. So that way, and that's on the relinquished property. That way, there's just your bottom line is zero. It just, for me, it's kind of like, show it to the IRS. Look, they got no money. So anyway, zero, nothing, as my roommate in college said, as he talked to a bank one morning, nothing from nothing is nothing. So he had apparently overdrawn his account. Just remember that story. It's kind of funny. Anyway, 1099 reporting, it is imperative your client has the section in the 1099 form that indicates this property is part of an exchange. Yes, make sure you do that. You'll notice on your 1099 reporting, there is a cute little box there. It says, part of an exchange. Make sure you check that. Go ahead, Drew. So again, we kind of just say these things with words through the presentation. This is some definitions. We're getting towards the end. Keep going. And keep going. That's it. So again, if you have questions, by all means, guys, please reach out. Like I said, we have our company, a family member of our company, Security Title Guarantee Corporation Baltimore. We do have a facilitator of 1031. So if you have a transaction, a client has a transaction, please reach out to us. We're happy to work with you guys. We'd love to help you guys out. And obviously, if you have questions on 1031s, let me know. I mean, if we're not the QI, that means I can give you a little more advice than if we were the QI. So that's, I think that's very helpful sometimes. So please reach out. But thank you, guys.
Great, thanks, Brent. Wanted to offer up our 1031 readiness checklist that we put together. If anyone would like, of course, it opens up on the other screen. But we have this available in PDF form. If you wanted a copy, put a note in the chat. Type 1031 in the chat if you want to be sent a copy of this 1031 readiness checklist. Basic eligibility requirements, signs you're a strong candidate, and then signs you might not qualify. Final reminder, who to call.
Yeah, we'll plug Sean here real quick. He was going to co-present with me, but he ended up at Southern Land Title Association. So shout out to those attending. But anyway, yeah, Sean is somebody. Obviously, he's the word nerd. I'm the number nerd. So between the two of us, we like to think we can answer most of your questions. And if we don't know it, well, we'll probably Google it first. And if we can't Google it, then we'll probably ask somebody else. So by all means, we try not to guess. How about that?
No, we have a great team. Brent and Sean are two awesome people to be at the forefront of secure 1031 exchanges LLC.
Thanks, Drew.
Thanks, Brent.
Thanks, everybody.
Thanks, everybody, hanging out.